Bank of England, the old lady of Threadneedle Street, started a blog. This, of course, under Governor Mark Carney, who pioneered central bank openness when he was at the Bank of Canada. Now to the Fed. The dots, the pressers, the notes, these are all innovations that let the Fed gently, slowly tell us what its plans are. Guest host Sri-Kumar is the president of Global Strategies. Sri, you are not buying it.
Forward guidance simply hasn't worked, Brendan. If you look at what happened with the Bank of England under Mr. Carney, as long as a year and a half ago, he was talking about raising interest rates. And then it turned out that the economic conditions did not allow that to happen. So he had to repeatedly postpone any rate hike, which we have not had at all since. In the case of the Federal Reserve, we have had economic growth forecasts since 2009 on which their forward guidance is based. And every year that growth forecast is missed. It's almost when the Fed makes a growth forecast, you know that it's not going to be hit. So essentially what the forward guidance does, Brendan, is, as you said before, it ends up in forward confusion. And what you have for the market is a lot of volatility that Tom has been talking about this week without actually helping the market stabilize itself. That's my complaint.
How do you get this right? Do you really want to go back to the Delphic days of Alan Greenspan when we had no idea what the Fed's plans were?
You do not want to be like a Delphic oracle giving speeches, but you want to give some indication of where you're headed. But to be able to have the dot plot on interest rates, which eventually may or may not be followed, and repeatedly indicating that the quantitative easing had come to an end and we resumed it. Interest rates were going to go up in 2014. We are approaching the end of 2015 without it. Those are the points that we can all do without. The markets would be better off without such quote-unquote guidance.
Is there any way to let the markets know we just don't know what we're going to do? When the Fed says it's data dependent, I believe them, and I feel like markets don't. They say, well, you do know what you're going to do, you're just not telling us.
I think if the Fed doesn't give any guidance, Brendan, and essentially you and I, as investors in the market, are allowed to play the game as we see best, we would have less volatility than with forward guidance.
Okay, well, then volatility is part of the game as well. Part of it is the parlor game of when will the Fed act. You are still in 2016. Ellen Zettner is one example, was there at Morgan Stanley. She's come back to a more constructive December. What are the ramifications if the September crowd has to capitulate to where Zettner is, or even worse, has to capitulate to where you are? No one's prepared for that, are they?
Well, they ought to be prepared, Tom, because all of those people who have been calling for rate hikes in the past have been postponing it.
Do rates drive down like Jeff Gundlach talks about because you get your call right?
I think even rates as in at the yield.
10-year yield.
Yeah, the 10-year yield, I think, is once again going to go below 2% and going toward 150. And I've been, even though it hit 250 recently, 250, 251, we are back to the 230 area. I don't see any basis with core inflation remaining so low, global growth disappointing, the Chinese...
So then you have dollar weakness by definition, and that's where you fold into a currency war.
That is exactly right. I think that's exactly what you have today. You have a currency war involving Japan, involving the Eurozone, involving the United States, and it's not ending.
Brendan, this is crucial in that these moving parts have scenarios or outcomes. Sri's is clearly an outlier call.
Right.
But so far, he's been really right about more tepid global GDP.
He has been really right, but also the problem with communication, you know, you were talking about, you know, your GDP call versus the Fed's GDP call. Necessarily, does the Fed have to be a little more optimistic than it should be? I mean, are they,
I don't think it should be, because as a market participant, you want your official agency, whether you call it the Fed or the Bank of England or a finance ministry, to be as close to being realistic as possible. You don't want your Fed to be a cheerleader. And then eventually every time disappointing the market because it doesn't work out, because then the markets lose faith in the forecast. Is that any good? If you keep being optimistic and everybody knows it's not going to be met. Which is why I think to be clearer on what it is, if they want to be data dependent, I think the way to do it is to say if the data fall in this category, we will raise interest rates. If not, we will keep them unchanged.